Are you ready, dear students? I hope so, because we are going to slug through a typical Form 1040 tax return for a homeowner. And it's not as hard as it looks. There's a lot of things that are just we should just completely ignore, and there's a few things that we have to concentrate on. But most people, when they take a look at the tax form and see all the lines and all the numbers, and they just want to run away, and I don't blame them. I don't blame them at all. But you are going to see that it really isn't that hard once it's been explained to you, until you have a special situation that requires the help of a professional, because some of these things are pretty darn weird. But the Form 1040 and the Schedule A turn out to be pretty straightforward for most people. Slide number 11. With the Republican tax cut of 2007, the IRS decided, hey, this is a great opportunity to overhaul the method of reporting our taxes. They scrapped the 1040A, which I'm kind of glad they did, but they scrapped the 1040EZ, which I think was very unfortunate because it was very easy. Everyone's now going to use the 1040. It has been simplified. It used to be 2 pages. It's still 2 pages, but now has an additional 3 schedules. Schedules 1, 2, and 3, depending on your situation. How could anyone possibly state with a straight face that adding an additional 3 pages makes it simpler? Add to that the confusion of which 3 pages to use. I'm still pretty confused. But take heart, dear students, in 2019 it was an additional 6 pages. Yes. I know, what can you do? I mean, this is what we're up against. But you're going to do fine. I just know it. Slide number 12. On the top part of page number 1 of the 1040 form, we put our identifying information. Filing status, name, social security numbers, address, dependents, signatures go at the bottom, and our occupation goes at the bottom of the second page, but we put that as identifying information. The social security numbers of dependents, mostly children, should be included, must be included, unless your child was recently born and then you get a grace period to go get the number. Don't forget to sign your return. If you forget, don't send another return. Contact the IRS. They'll send out a form called an affidavit, which is saying, hey, this is my signature here. Before 1987, the IRS did not require dependents' social security numbers to be placed on the returns. And then they started in 1987. In 1987, the IRS started requiring taxpayers to include the social security number of dependents, and mysteriously, 7 million children and other dependents disappeared. Would Americans cheat on their taxes? Anyway, let's take a look at the identifying information. The filing status, married, single, married, filing jointly. Remember, you don't want to file separately unless there are knives and court orders involved. Head of household, or the qualifying surviving spouse, widow or widower. And in our hero's situation, he is the head of a household. Now, parents, you both can't be head of households if you've separated. Only one of them can. And in this case, it's A. King Back. A. King Back. And there's his social security number. And he puts in his address. Make sure they know how to contact you, because they will not call you. They will not send you an email. They will send a letter to you. So make sure they have the most recent address. Do you want any money to go to the presidential election campaign? Did you receive or did you sell any cryptocurrencies or other digital assets? Most people will say no. And most people will not be claimed as someone on their taxes. Unless you're very young and just have this part-time job going to school, you might be claimed by your parents or other guardians. Are you blind? Are you 65 or older? They want to know. And then here's where we put down the dependents. And so A. King has a son, Wayne Wayne D. back. Wayne D. back. Don't forget to put his social security number. Don't forget to put his relationship. You know, folks, for years, I don't know, probably people are still doing it, but in the margins, people would write, IRS sucks, taxes are illegal, you are stinky people. Or they would forget conveniently not to sign, they would forget to conveniently forget to sign their tax return. You know, the IRS are people too, and they got sick of this. So they went to the Congress and said, we got to get rid of these frivolous and nuisance returns. So if you do something like one guy who sent his 1040 form on the back of a T-shirt, if you do that, they can fine you, and I think the fine is $1,500 per nuisance, per frivolous return. So don't do that. Okay? Yeah, cool. So now let's go back. And last time I did this, I messed up my recording here. Let's go back up. That's not what I meant to do. Okay, yeah. So that was the identifying information. Goes at the top of page 1. Now let's take a look at the middle of page 1. Here's where we put in all the income. Not all, though. You'll be surprised. There's a lot of different forms of income. But let's take a look at the biggest forms of income. And they go on slide number 1. I mean, line number 1. I'm sorry, line number 1. This is the one that most people have, folks, right here. This is it. This is it. The W-2 form that you get from your employer. And maybe you might have some other employee wages somewhere. Actually, this is supposed to be down here under tax. This is a mistake. This is supposed to be down here. This is household employee wages. It's supposed to be down here under taxable interest. I'm going to put it right now. See the power of these forms right here. I'm going to get rid of that guy right there. And then I'm going to put this guy here, 21. This is preparation of classroom materials on the fly, dear students. So let's, other income from line 1, number 10, line number 2. Capital gain, total income, add line 1Z plus line 2B. Oh, wait, 2B. Well, taxable interest goes right there. Oh, that's a mistake. I get that. See, I'm fixing this on the fly. So it shows you it's not that hard to do. And we put an extra 9 in there. So let's fix it out. And so here we are, other income from line. Okay, so this is the income, folks. This is the income. My apologies. I put it here in the wrong place. I'll fix the other ones. I promise. So what's going on here? Most of these things you're not interested in. For the vast majority of people, it will be line 1A. And you may have some interest from a savings account or a checking account. Most people won't, but A King's got $100. So, oops, that's supposed to be 1,900 there. You see what your professor's up to? Okay, so are you interested in most of these things? No. Well, maybe once you're retired, you might have IRA distributions or pension or Social Security benefits. You might have a qualified dividends from stock purchases, capital gains, but most people aren't going to have these things. So what are you interested in? You're interested in this one right here, 1A, maybe 2B, but that's about it. Where's the unemployment compensation? I think that's up here somewhere, right? You might have some unemployment compensation. Where is that? I'm not finding it. Maybe it's on one of the other schedules, which we'll take a look at in just a bit. Okay, so that was the middle of page number 2. Page number 1. So let's go back here. I'm not finding, because unemployment compensation is one of the ones that is very typical for people. But let's now take a look at schedule number 1, because on line 8, you see it says, okay, other income from schedule 1. And this is what used to be on the 1040 form, but now they've created a whole other schedule. Let's make sure I got schedule 1. There it is. And so these are items that you might have income from the Alaska Permanent Fund. Where's unemployment? Here it is. That's the one I was looking for. This is typical for many people. So it used to be on the 1040 form, and you didn't have to worry about another schedule. Alimony received, tax refunds. Yeah, so from the state or local taxes. Business income, this is if you have business. So if you're in this situation, you're probably going to want to get help to help with your taxes. Maybe the first couple times, maybe you want to use one of the tax preparation software because they work, they work. And if you just slog through, you can go online and get some help. But eventually, most of these things, jury duty pay, many people don't have jury duty pay. Olympic and Paralympic medals and other prize monies. I mean, just how many people are affected by that? But some people are. So that's Schedule 1, and then we'll see the other side is the adjustments to income. So we're going to look at that in a bit. But Schedule 1 has all the other weird ways of getting paid prizes from lotteries or something like that, but we're not interested in those. So notice that we have, oops, see, that happened again. Why is it doing that? My apologies. It's not supposed to do that. Now I have to go all the way back and start over again. This is the second time this has happened. I'm having a trouble here. Okay, so let's get it started. Again, my apologies. My apologies. Come on, sweetheart. Got to talk nice to your computer. Okay, my apologies. That's happened twice, and I stopped the last time, and I'm not going to stop this time. My apologies. So we have all these different types of income. Now back to we got all the weirdies from a Schedule 1, and here we go. On line 11 is our of the 1040 form is our adjusted gross income. That's supposed to be 6. Yeah, because what we do now is we got our total income here on line 9. So that's most people it's going to be just one or two things. Maybe they're going to have some stuff from Schedule 1. Typically, no. So here's our total gross income. And now we're allowed to adjust our income. We're allowed to take some things off of our income, and those are called adjustments. Not deductions, they're called adjustments. So let's go take a look at the second page of Schedule 1. The second page of Schedule 1 has all these adjustments to income, like educator expenses if you're a teacher, a penalty on early withdrawal of savings if you've put money into a SEP IRA, a simple IRA, or other qualified plan, usually for self-employed people. And so these are things we're able to take out of our income. So we're going to only do two of them. We're going to do the IRA deduction because A. King put money in an IRA, and then he has some student loan interest. So we'll just do those. Everything, and look, they even put things reserved for future use. I mean, are you trying to confuse people? Oh, well, I guess they're doing a good job. But most of these, forget it. We're not interested in it. We're not interested in attorney's fees and home. No. We are going to just take these two, the IRA deduction and the student loan interest, and total them up, and you get $2,000 down here. So we take that number, go away, get out of the way. Get out of the way. Can't get this guy out of the way. No, he won't go out of the way. There it is. It says enter here and on Form 1040, line 10. So we go back to 1040. On line 10, there's the $2,000 of adjustments, and we subtract that from the total income, and we get our adjusted gross income. So now let's see if I can get back to the presentation without messing everything up. Okay, so there we are. Line 11, the adjusted gross income. The adjusted gross income is an important number. Many tax items are tied to adjusted gross income, such as the ability to contribute to retirement accounts or utilize certain deductions and tax credits. So now we're going to take a look. So here is where we review what we just did. The additional income on Schedule 1 is on the first page of Schedule 1, and that total additional income was copied to the 1040. And then the adjustments to income are on the second page, the back page of the Schedule 1, educator expenses. All we're going to do in this class are IRA contributions and student loan interest. So we total that up on the page 2 of Schedule 1. See, it all used to be on the 1040 form, but they've added so many, so now they have to have a whole new schedule to confuse us. My apologies. All these items used to be on the previous 1040 form. So Now, here's where it starts to get, have I confused you yet? I apologize if I have, but it's starting to get tricky now. Because here's where a lot of confusion occurs. People will say, oh, I just gave a car to Father Joe's Village, and they said I have a $2,000 deduction. And you bring it to your tax preparer, and they say, well, do you have any other deductions? Do you own a home? Have you had serious medical expenses? And they say, no. Well, you know what? You don't get to take advantage of that. Because everybody gets to take advantage of the standard deduction, which for single people is $12,950. For a married couple, it's twice that, $25,900, and then there's the one for the household, head of household, and then married filing separately. But so you have to have, if you're single, at least $12,950 of deductions to take advantage of those. Anything above that. Or if you're married, $25,900. And these were raised significantly in the Tax Act of 2017, because they got rid of personal exemptions, which used to be every person had a personal exemption. They got rid of it and upped the standard deduction. Well, what happened then is a lot of people in the middle class and lower middle class who owned homes could no longer use their home mortgage interest deduction because they just didn't have enough deductions. It makes it easier, but they don't get to take advantage of the itemized deductions, because you get to take the standard deduction or the itemized deductions, but you can't take both. Understand? You cannot take both. You can only take the standard deduction or the itemized deductions. Now, what are the itemized deductions? Medical expenses, state and local taxes, interest paid to mortgages, charities, casualty and theft loss, and there are many others. And if the total of your itemized deduction is not greater than your standard deduction, then it is more beneficial to take the standard deduction and pay fewer dollars in taxes. Now, where are the deductions itemized? They're itemized on Schedule A, and we often call the Schedule A Homeowner's Friends. So now we're going to go back to the 1040 form. I'm going to get rid of Schedule 1 so I don't get confused. There's the 1040 form. Now notice A King's, how do you get rid of this thing? I don't think you can. I don't think that's it. A King's gross income was $62,000. His adjustments to income were $2,000, so his adjusted gross income is $60,000. Now here's where it says, put down. See, it says standard deduction or itemized deductions from Schedule A. So notice it tells you right over here what the standard deductions are. For a single person, it's $12,950. For a married couple, it's $25,900. That's actually double that. Head of household is $19,400. So if you are single or married filing separately, use this number. Widowers get to use this number, and that's why it pays for them to file as married, as a widower or widow, they get 2 years after the person dies, not including the year in which they died. So it's actually 3 years. Okay, now, are you confused? I understand it's confusing, but go back and listen to it again, and you'll see that you get to take the standard deduction or itemized deductions, but you can't take both. Now, we said that the head of household deduction was $19,400, right? But what did A King take? He took $22,000. So his itemized deductions are greater than the standard deduction of $19,400. Okay, can he just write this number and leave it there and let the IRS say, okay, yeah, I believe? No, he has to go to Schedule A, and here is Schedule A, and on Schedule A, he has to list all the itemized deductions. Well, now notice, he doesn't list any medical deductions or dental deductions. Oh, wait a minute, he's got a kid, you figure he's got, no. It has to be at least 7.5% of your adjusted gross income for you to take advantage of the medical deductions. So in other words, in A King's case, he has an adjusted gross income of $60,000. He has to have at least 7.5% of $60,000, which is what? That's like, $4,000, $5,000, before he can take advantage of his medical expenses. Anything above that, he could. So if he had a major surgery or a major illness, he could take advantage of that. You don't want to take advantage of it because that means somebody's sick in the family. So notice he leaves it blank. But he did pay state and local taxes of $1,000. He did pay real estate taxes of $3,900, and he paid DMV tax of $200. And so the total of his state and local taxes, sometimes you'll hear people say SALT, the SALT taxes, are $5,100. Now notice the Republicans, they wanted to stick it to the higher income areas like California, New York, Chicago, and the like, because they're Democratic, so they wanted to stab them in the back, and they did. So they've limited this to $10,000. So many people who have high mortgages here in San Diego and California and New York and the Eastern Corridor and Chicago and up in the Bay Area, up in Seattle, they were not happy about this. They were not happy. It turns out they were pretty darn angry, and in 2018, they voted out a lot of Republicans. Here closer to home, Orange County, it's always been very, very Republican. All 6 of them lost their seats in 2018 because people, they vote their pocketbook, and they were very angry. Now, a couple of them are back, got back because the Democrats, of course, are communists and socialists and woke individuals, so we have to hate them. But I'm equal opportunity. I hate everybody. But it really was a bit of a nasty thing that they did. But they did it. What are you going to do? So there's $5,100. But wait a minute. We said that the standard deduction was $19,400. So are his state and local taxes going to push him over the edge? No. What's going to push him over the edge? His mortgage. Here it is, folks. That's what we call the Schedule A, the taxpayer's friend, because he has that home mortgage interest deduction of $16,200 that he paid, which is typical. Actually, it's on the low side nowadays with mortgages so high. But we're going to see that the Republicans limited that too for people with big mortgages. And so now we've got $5,100, $16,200 in home mortgage interest, and he gave $700 to Father Joe's Village or Southwestern Community College Foundation, other nonprofit charities. And so there's the $22,000. Add them all up. Now here, typically we don't have casualty and theft losses and others. And so $22,000 are his itemized deductions. So you send that schedule in with your 1040. Do you have to send in the receipts? No. Should you keep the receipts? Yes, because they might send you a friendly little letter saying, okay, you said you gave $700 to Father Joe's Village. Show us the receipt. Then you got to send it in and make a copy. Make a copy. Don't send the original. Got it? Okay, let's see if I can not mess up myself again. Here we see. Yeah, we did mess it up. So you hear? You get to take the standard deduction or the itemized deductions, but you don't get to take both. And it's going to sound like a test question. Yeah, it's going to be on the test. And then here is what we just went through. We went through the Schedule A. Many other deductions were also removed by the Republicans in 2017. And so this is what we just went through. The medical expenses must be at least 7.5% of the adjusted gross income. The first 7.5% don't count. The state and local taxes are limited to $10,000. The mortgage interest is now capped on the first $750,000 in mortgage, and for homes purchased starting in 2018. Gifts to charity, casualty, other deductions, and total deductions on line 17. So, all right. So now let's go back to the 1040 form and see that we took that $22,000 from line 17 here and put it over here under standard or itemized deductions. So now we can get rid of Schedule A because we've gone through that. So line 13 is only for people who have a business. It's a qualified business income deduction. It's one of the things that was added. It was meant to be sort of a corollary to what they were given to the corporations. There was one guy, I forget which one he was, one of the senators said, you got to do this for the people, not only just for the corporations. And they said, okay, we'll do it. So they give them a qualified business income deduction. It's nowhere near as generous as what they did to the corporations. But let's put that back there. Okay, yeah, here it is. Deduction of up to 20% of small business income But Forbes is not happy. It's really kind of vague and very complicated. The provision is rife with limitations, exceptions to limitations, phase-ins and phase-outs, and critical but poorly defined terms of art. But as we said, it was meant to mirror the tax cut that corporations receive. Most people will not be will not be affected by it. So then you total that on line 12 and line 13 on line 14, and we get to compute finally line 15. We get to take our $60,000 in adjusted gross income minus the $22,000 of itemized deductions, and finally we now know line 15 at the bottom of 1040 what the taxable income is. So you'll find that is then we start again on page number 2 now. So we now know how much income A King is going to be taxed on. Okay, so let's go back here. I got to find a way to go back there without messing it up so it goes to the next line, but I can't do it. So here, we have finally determined how much of our income is taxable income. We can now compute our tax due on line 16 on the second page. However, there are a few methods, and we need to determine which method we need to use, but most people are going to use the tax tables. If you have $100,000 or lower of taxable income, you're going to use the tax tables. If you have more, you might use the tax rate schedules. If you have a lot of capital gains, which is typically for very wealthy individuals, you might use Schedule D, or you might wind up being affected by the alternative minimum tax, which we hope you don't, but you might. So most people are going to use the tax tables. So let's go use the tax table. Remember, the number was 38,000, right? 38,000. So what we're going to do is we're going to run over to the tax table, and this is going to really freak people out who hate numbers, because this is all it is, numbers. Whoa, just look at all those numbers. Whoa, well, we're looking for 38,000. Keep going, Piano, keep going, keep going, keep going, keep going. Here we finally have made it to 38,000. And what we have to look at is which column to use. Notice it says at least but less than. As soon as you hit that number, you got to go to the next row. So single, married. This is the only one. We want this shaded one. Let's go back down to 38,000. Whoa. So we can't just use this guy where it says 38,000. No, as soon as you hit that number, you got to go to the next row. So here it is for A King. We're not looking. Did I say married filing? No, we want head of household. He's not married filing separately. He's head of household. And that's 4270. See that number? 4270 for head of household. Okay, so now we go back to the Form 1040. I did it right! Yay! I did it right. And that's pretty much most people are going to have to worry about. Now, if you have other taxes, that's on Schedule 2, the AMT, and a few other types, the alternative minimum taxes is called, and a few other types of taxes. But most people are not going to be affected by that, so we can ignore that. So we add lines 16 and 17 and get our tax. So now we know how much tax we have to pay. No, we don't. We now have to think about the credits that we may get, because tax credits are very cool. So let's go back to the presentation. I'm sorry, before we do that, we're going to discuss the marginal tax rate. Remember, we mentioned this marginal tax rate in passing on the first presentation. Well, we have what's called a progressive tax system. It starts off at a low percentage, 10, then goes to 12, 22, 24, 32, 35, and 37. The more money you make, the more your marginal tax rate goes up. And so the first certain amount you pay 10%, the next amount you pay 12%, upwards and upwards. This is versus what's called a flat tax, where it's very promoted by some people, where everybody pays 20%. Everybody pays whatever, 9%, 15 or 20, or people throw numbers around, but it's about 20%. And we'll discuss this in just a minute. There are more issues that we will revisit after we discuss marginal tax rates, specifically tax credits. So let's now take a look at the marginal tax rates for 2022. For single people, the first $10,275 of taxable income, this is after we've gotten to line 15, after we've put all the gross income and then taken out the adjustments and all the deductions, standard deduction or itemized deductions, the first $10,200 is taxed at 10%. Now, between $10,275 and $41,775, we are taxed at 12%. You see, the first 10% is taxed at, the first $10,275 is taxed at 10%. But as soon as you go above that, all these dollars, they don't go back and recompute the first $10,275, but all these dollars are taxed at 12%. And then once you go above $41,775 up to $89,000, it's taxed at 22%. 24, 32, 35, and 37. That's for a single person. Notice for married people, it's essentially doubled. The first $20,550 is taxed at 10%. Well, that makes sense. There's two people. And then between $20,550 to $83,550, it's taxed at 12%, 22, 24. It's a progressive tax system. The more you make, the higher the percentage you pay on the next dollar of income. Not on the, they don't go back and recalculate the first dollar. Some people think, oh my goodness, they're going to, no. But this makes sense. If you think about it, somebody who's making $200,000 has already paid for the milk and the shoes and the rent and everything. Somebody who's making $20,000, $30,000, it's a lot harder for them to make it. So the idea is to tax people making more money. You tax them higher. It's the progressive system. The 2017 tax cuts gave the average poor family a tax cut of $60. The middle class saw an average cut of $930. People between 95th and 99th income brackets got over $13,000, and the top 0.1% saw an average cut of almost $200,000. Once the plan is fully phased in, though, by 2025, taxes go up for the bottom 40%, unchanged for the middle 40%, go down slightly for the 80 to 99%, and fall sharply for the top 1%. Surprise! I remember President whatever his name was, the previous guy, saying, there's no way it's going to help the top 1%. And he turned to his treasury guy, who happened to be the Mahatma at Goldman Sachs, and said, is this going to help you? It's not going to help me. It's not going to help me. Is it going to help you? And he said no. He was lying. He knew he was lying. You could tell on his face he knew it was lying. Gary, I forget his name. But it's just, that's what they did. They were very smart. They took it. Good for them. Okay, now watch what happens. Watch. 0 to 10,275. Watch what happens when we go back to 2021. Oops, it went down. Well, actually, it went up in 2022. You see? What they do is they index the marginal tax rates to inflation. That way, as inflation goes up and you make more money, you don't wind up in another bracket just because inflation went up. So in 2021, you only paid 10% on the first $9,950 if you're single, and then between $9,950 to $40,525, you paid 20%. Double it for married couples. From 2001 until the end of 2012, the tax rates were temporary and adjusted every couple of years. After the fiscal cliff fight at the end of 2022, the rates became permanent until they were changed by the Republican tax cuts of 2017. They are now temporary. And the idea was the Republicans vowed to make them permanent by 2025, but of course by 2018 they had been decimated out of the House, so they never got their chance. So we're going to have to deal with it by 2025. I don't know if we're ever going to do it. We can't get the people in Washington to make nice and play. We have identity politics, and we're fighting amongst ourselves and red versus blue, and it's pretty scary, folks, because back in the 1950s and 60s, during the Cold War, the Soviet Union knew there was no way possible for them to militarily defeat the West, specifically the United States. They knew that the only way the United States would fall was from within. And they didn't have the tools to do it. Now they have some tools, and they're using them, like Facebook, and Twitter, but we're doing it to ourselves. We're shooting each other, and it's scary. Economically, as I said, I'm very, very excited about the future, what's going to happen with technology and our standard of living around the world. Politically, I'm scared to death because these people are nuts. Okay, slide number 21. What's going to happen? So we're going to go back to 2020. 9,950, 9,875. Inflation was very low because of the COVID. The rates normally do not change. Notice they always stay the same. The tax brackets are simply adjusted upward according to the inflation rate. The 2019 brackets were lower than the 2020. The 2021 were lower than the 2022. And again, these tax rates are all going to fall back to what they were before the 2017 Tax Cut Act, because they were just made temporary. And in 2025, the whole thing reverts back. So the Democrats and the Republicans are going to have to work something out. I hope they do. Slide 22. And so here's an example of how it works. Let's say you're single and you got $42,775 of taxable income. Remember, this is after the adjustments, after the deductions. This is your taxable income on line 15, bottom of the 1040 form. The first $10,275 is taxed at 10%. So that's $1,027. 10,275 times 10% is $1,027.50. Between $10,275 and $41,775, it's taxed at 12%. So we subtract these two, multiply by 12%, and get $3,780. Notice we don't recalculate the first $10,275. That was calculated at 10%. And because this person now goes over the $41,775, whatever they go over that, in this case it's only $1,000 because we said they have $42,775, is taxed at 22%, which is $220. And you add those three up, and this person's going to owe about $5,027.50. Well, not about. That's what they're going to owe. Hey, now notice that we don't, because this person didn't make more than $89,075, they don't move into the 24% tax bracket. You see, the next dollar you make is always taxed at your current marginal rate. Does that make sense? Okay. Now, what happens? If we have if we want to calculate the average tax rate, we just take that $527.50 and divide it by the $42,775, and we get about 11.8%. So even though they're in the 12%, the 22%, they moved to the 22% tax bracket, the whole average tax rate on everything was only about 12%. And this is useful, if only to debunk people who talk about a flat tax. They say the flat tax is fair. They call it the fair tax. It should be called the unfair tax, because people who are making 200, 400, 800,000 or more, to them, 20% is not as much as somebody who's making 40,000. 20% is a hell of a lot more, and means the difference between, being able to live a living wage. And that's why we use the progressive. I know the progressive word is demonized by many people, and that's why we use it. And it does make sense, in my humble opinion. Call me a communist, whatever. I'm a stockbroker. But it just makes sense. And notice that it has all the bravado regarding the flat tax, the fair tax, whatever, just never actually gets anywhere. And okay, so let's go back just real quick and show you the 527.50 divided by the 42,775. That's what got us a little under 12%. Who would win? Who would lose in a flat tax? Well, the people at the top would win with a flat tax. The people at the bottom would lose, and that's just the way it is. Now, if you want them to lose, if you want them to win, that you decide. Okay. All right. Now, the marriage penalty, slide 24. If the marginal rates are higher for single taxpayers, how come we sometimes hear people complain about the so-called marriage penalty? Well, they haven't been complaining about it because Congress has removed it, except for the people at the very top. Because the second wage earner in the family pays their taxes at the highest marginal rate, they do not get to take advantage of the lower tax brackets. Married couples with only one wage earner actually get rewarded, not punished. But of course, they need more money. They're two people. And so this is what affects people who, the one person's not working. Maybe they stop working to take care of the kids. And now the kids are a little older and they say, let's go back. I'll go back to work, right? What they don't understand is that their income is going to be taxed starting at the marginal rate. They don't get to take advantage of the lower rates. You're at maybe you're at the 12% or 22% tax bracket. That person comes in at that bracket. They don't get to take advantage of the 10 and the 12% bracket. In 2017, Congress removed the marriage penalty for all the brackets except the very last one. Notice that this is not double. All the other numbers are doubled. 10,275, 20,550. So they created a new marriage penalty, right? Both single and married filers have the same $10,000 state and local tax limitations. See, to be fair, if you were married, they would have bumped that up to $20,000 state and local limitations, but they didn't, right? So yet another attack on the blue. I hate that, folks. Red and blue. It's in our language. It's in our culture. It reminds me of blue and the gray, right? The Civil War. We've divided ourselves. The weird thing is that there are no red states, there are no blue states. There are red areas and there are blue areas. Typically, the red areas are rural and the blue areas are urban. So you go to California, you think California, oh, it's so blue. You go to some of the areas in California, and these people are red. They are very angry at progressives and woke individuals and communists and the like. And you go to urban areas, and they're much more liberal. One of the cities in Texas, Austin, they have a very liberal reputation, and their motto is "Keep Austin Weird." But they're in the middle of we're gonna kill ourselves, folks. We're gonna take ourselves down. I hope not, but it's happening. History, you can watch it, but it's a movie, and sometimes the movie doesn't end well. It ends badly, and I think if we don't do something, it's going to end badly. My humble opinion. But economically, I'm pretty excited. Slide 25. The dreaded AMT, Schedule 2. We're not going to deal with it because most people are not affected by the AMT. It was originally meant to make sure everyone who could afford to pay some taxes would pay some taxes, originally targeted to the very wealthy. However, the AMT was never indexed to inflation. And it was started in the late 1960s. $100,000 was a very unusual and substantial income in the late 1960s. But that's not true anymore. The AMT is affecting more and more people as the middle class, as the wages continue to climb with inflation, especially two-income families in the blue states. Every year the Congress passes an exception because when they don't, a lot of people are going to get really angry because they're going to think this is how much they owe, and all of a sudden they're going to get another bill. Oh, you forgot that you owe this much for the AMT. It was eliminated in the 2017 tax bill for businesses, but not for individuals. Slide Let's go back to the 1040 form, and now we're going to take a look at lines 17 and 18. Are you still with us? Just come on, stick with us. We're in the home stretch here, folks. Okay, so 17. What was it? What was I looking at? AMT. Yeah, that's here. 17 here, and we don't have to worry about that. Most people do not have to worry about Schedule 2 with other taxes, but some people do. We don't have to. Okay, so let's go back here and see if I mess this up. I didn't. Oh, I hope I didn't. Oh, okay, I didn't. Now, tax credit. Finally, let's talk about something fun. Tax credits. Yes, tax credits are cool. Tax credits are a dollar for a dollar reduction in taxes. And if you have children, you know this, or you should, because you get a $2,000 tax credit for each child under 17. Now, during the COVID crisis, they bumped it up to $3,600 for children 5 and under and $3,000, but now it's back down to $2,000. And then there are some, these are refundable, by the way. If you make not enough money to not pay $2,000 in taxes, they'll still give you, maybe you made $1,600, you have to pay $1,600, they'll give you $400. They'll get rid of the $1,600 tax bill and give you $400. That's called a refundable tax credit. But that's unusual. Most tax credits for child care, education credits, retirement savings credits, energy credits, foreign tax credits, they are non-refundable, which means if you don't have a tax bill to apply the tax credits to, you just don't get to take advantage of them. Oh well. So let's go back to the form and take a look at the child tax credit. Notice that's a refundable one, so that's up here. And then we have $2,000 because he's got a son, $2,000. And then where the other ones are down here. The refundable ones, the refundable credits are back down here. So we're not going to deal with them because he doesn't have any refundable credits, non-refundable credits. But he has the refundable credit, the $2,000 of tax credit. Now, notice his tax bill is $4,200. If his tax bill was only $1,200, he would actually get the extra money back. He would zero out his tax bill and then get the extra money back. Okay, but in this case, he's got $4,270 in taxes and $2,000 in the tax credit, and so he gets to add those tax credits up, and then if you have any other credits here, and here it is, $2,270 now in taxes. So you got to wipe out $2,000 off of his tax bill. Very cool. That's what you get if you have a kid. Is it worth it? You have to decide. Some people say, let's go have a lot of kids to get our tax bill down. They're going to cost a lot more than that tax credit, in my humble opinion. And then there might be some other taxes, which we discuss here. Let's go back here and see if we can get here without messing things up. We did. There might be some other taxes, Social Security taxes for those who are self-employed, household employment taxes, any Affordable Care Act taxes, penalty withdrawals. But most people are just not going to have this, folks. So you notice it is 0 on his on line 23. So finally, on line 24, now we know how much money we're going to have to pay the IRS, $22.70. So remember that. Let's go back to the slide and hope not to mess things up. Because here we go. So we finally made it. Now we know how much we owe. Well, maybe not. It depends. But let's go to slide number 26 and discuss tax credits very quickly. Tax credits are very cool. You see, a tax credit reduces your tax by dollar for dollar. You have a $100 tax credit, it reduces your tax by $100. Now, if it's refundable and you don't owe $100 in taxes, the IRS will give you that $100. They'll refund it to you. Most tax credits, as we said, are non-refundable, which means if you did not owe $100 and your $100 tax credit, oh well, you don't get to take advantage of it. A tax deduction, though, only reduces your taxes by the marginal tax bracket, which I hope by now you kind of understand. If you're in the 22% tax bracket, you have a $100 tax deduction. That means you're going to reduce your federal taxes by $22. And let's say you're in the 7% California tax bracket. That's going to reduce your taxes by $7. So a $100 tax deduction only gets to reduce your taxes by $29. A $100 tax credit, yippee, reduces your taxes by $100. Never a reduction in Social Security taxes. There's no credits for those. So, sound like a test question? A tax credit is an amount subtracted directly from the amount of taxes due. Tax credits are worth more than tax deductions. Excuse me. I'm getting tired too. Okay, here it is, the little snitch, the W-2 form that tells the IRS how much money you made last year, how much you paid in income taxes, Social Security taxes, Medicare taxes, and then if you have local tax, state and local taxes, it would show that. This one doesn't show that. But there it is, the little snitch. And yes, they send it, your employers send it to the IRS, so don't act like they don't know. They do. Now, on line 25 is where you're going to put the withholding. There may be some other payments that you've made, but most people, that's the only thing they're going to have. They're only going to have what they withheld from their employer, what their employer withheld from their paycheck and sent to the IRS. Now, you may be self-employed. You may be unemployed. You might be self-employed, in which case you have to send your own withholding in. And so that'll be a different line. But the idea is the IRS and the courts have agreed, says that it's a pay as you go. You can't wait until you file your taxes to pay all your tax bill. You have to pay throughout the year. And what happens is most people get a large refund. They have too much taken out. And they start to depend on it. Well, folks, the best thing to do is to estimate your tax bill, 90%, 100%. What do those two numbers mean? They might mean something important. And owe $100 or get back $100. Because sure, if you're looking at it as a way for a vacation fund or whatever, that's fine. But if you're looking at it as a way to pay down your credit card debt, no. Pay your credit card debt down throughout the year by reducing how much money you're sending to the feds. And because your credit card's at 25%, that's a better way to do it. So let's run over and take a look at the 1040 form and show us how we put this number in, W-2, any 1099s, other forms, but estimated taxes for people who pay estimated taxes. But most people, no. They're only going to have this puppy right here, the amount that was withheld from their payroll. And then here's some of those tax credits we talked about. Notice they're after the tax, after the payments, whereas the other one is before the payments. That's why it's called refundable. And so here we have he had taken out, they took out $2,400, $2,400. And so $2,400 is how much his payments were. Here are the any other credits here that we discussed here, and which he doesn't have. And so here it is, $2,400 of payments. He owes $2,270. His employer withheld $2,400, so he overpaid by $130. Now, if this number were less than this number, you would have to go down to here and put in the amount you owe, and then you'd have to maybe pay an estimated tax penalty. We'll talk about that in a bit. But in this case, he's going to get a refund of $130. Now, make sure you say, okay, the IRS is sneaky, right? It's okay, you overpaid by $130, and then you have to say how much you want refunded to you. If not, they're going to say, oh, he wants to roll it over. She wants to roll it over to next year. Okay, well, hang on to it. Like, no, give it to me. And then you put in the routing number and the check number, unless you want to check. And see, you could also say, no, I want it applied to next year. No, don't do it. Well, if you want to, you decide. Roll it over. I do know one gentleman who always did that. He always just rolled it over. He didn't even want to be bothered. I thought, okay. He was self-employed though. And then, so here we go. So let's run back here to the presentation. We're finally done. Is it that difficult? Yes, it's very tedious, folks, but It's not that hard once somebody shows it to you, in my humble opinion. I think so. Now, remember, did you sign it? Now, I used to be able to sign it I used to be able to take the PDF file and put a signature here that was phony and a date that's phony. The new PDF files, you can't do that. They've taken away that ability. You can't put a written signature using an image file, but you still can put in your occupation. And of course, what is A King back? Well, he's a mattress tester. Of course he is. Okay, anyway, so my apologies. We used to be able to dump a signature here and a date and make it look real professional, but we didn't. And let's put in some routing numbers just for kicks. 32228578 6, and then an account. It's a checking account. This is all made up stuff. Don't try to use this at home, kids. And then 08574. No, it's not working. Come on, let's put it in there. 879. There it is. Okay, so this is phony information. I'll put that in there. But it's a good idea to put your routing number and your account number. That way they don't have to send a check. It saves money, saves resources, and it's safer and takes less time. Okay, so that was our 1040 form. Was it really that difficult? Yeah, I know, folks. Go back and look at it again. It's confusing, but that's our tax code. Now, how do you avoid common filing errors? Check your arithmetic twice and then check it again. Attach the necessary documentation. The feds, if you do it by mail, they want you to attach that 1040, the form W-2, the W-2 form. State of California doesn't want you to do that. Put your social security number, the tax year, the tax form, the form number on the check, 1040, form 1040. Make your check payable to the United States Treasury, not to the IRS, United States Treasury. Keep photocopies, put proper postage on your mailing envelope. Better yet, file electronically for free. Volunteer income tax assistance. You have the ability, depending on how much money you make, most people can, to go to Southwestern Community College and other places in the South Bay and find it's called South Bay Community Services that runs it, and they do it here on our campus. And we have students who are involved. So you could be one of those students, and we've already said this, learn how to file taxes electronically using their very sophisticated system. You'll get college credit, and you'll get a certificate saying that you are qualified to do this. And it's very cool. And it's a lot of fun. It's a lot of fun, I thought. If you need more time, file an extension, either online or by paperwork 4868. Cool? I know. It's a lot, folks. But you do it again, slog through, you'll find it's not as hard as it seems. So, last couple of slides here, folks. No. If you find you made a mistake, should you leave the country? Commit suicide? Pretend it didn't happen, which is what some people do. They pretend it didn't happen. Or file Form 1040X. The correct answer, of course, is to file Form 1040X. Yes, do it before they catch it. The IRS takes a long time, folks. They can take a year or more to catch an error. They're so backed up. That's why the Congress, before last year, said we have to really give the IRS more money. And now the Republicans are saying, no, we want to take it away from them because they're jerks. And the IRS is saying, but we don't have enough resources. Oh, what a mess. Okay, so file Form 1040X. Sometimes you'll get money back. If you made a mistake, it might be in your favor. So catch it before they do, and they'll be duly impressed. And now, oops. Don't forget the state of California. Once the federal 1040 is finished, you get to tackle the state of California's Form 540. And fortunately, it is far less than half the work. It's usually just two forms, the 540 and the 540CA, which stands not for California, but for California Adjustments. What? Well, for example, the IRS, the feds, tax your unemployment benefits. The state of California doesn't. If you had unemployment, they don't tax that. The feds let you They let you take a deduction on your state income taxes. The California doesn't. But if you get a refund, the Fed say, oh, wait a minute, you told us you paid X amount of money for your state income taxes when you actually paid X minus 100. You had a $100 refund, so you have to pay taxes on that. So there's a few adjustments that have to be made. You with me? Yeah, I know. It's not fun. It's kind of yucky, but you can do it. And the cool thing is, you can make money doing this. There are people who are tax preparers, and the cool thing about that, you will never, ever not have business, because the tax code only gets more and more complicated, and people more and more just get completely frustrated, look at all the numbers, look at all the lines, and just say, I don't want anything to do with this. And you could be one of them that says, I can do it. And you know what? The dirty little secret is it's all computerized now. In our next presentation, we'll talk about some of the computer programs that you can use to do it and find it's really not that hard. These CPAs, they don't even do it anymore. They just give it to their assistants and say, hey, put all these numbers in. And if you find a place where you get confused, come talk to me. Yeah, my apologies. So are you proud of yourself? I hope so. Go back over, go through the tax form, tax exercise number 1. There's a tax exercise number 2, and then there's assignment, and we are proud of you. We want you to be awesome. In our next and last presentation for Chapter 3, we'll take a look at some sources of information, software programs, and audits. And then we'll take a look at some tax reduction strategies. Thank you so much for being in our class, folks. Go get them. We're proud of you.